Hey, M&A scientists. Let's talk about one of the biggest time and cost sinks in deal making, contract review. Every deal comes with a mountain of contracts, employment agreements, customer contracts, vendor contracts, you name it. Buried within those hundreds of pages are crucial details like change of control provisions, consent clauses. Those are the things you need to get ahead of. Traditionally, combing through these contracts takes hours, sometimes hundreds of hours. But what if we could reduce that time by 80%? With DealRoom AI, you can. Our AI-powered contract analysis tool scans and extracts key information from all your contracts in minutes. No more spending countless hours hunting for risks. DealRoom AI highlights critical clauses instantly. And here's the best part. It's incredibly easy to use. No special training, no steep learning curves, just upload your contracts and let DealRoom AI do the heavy lifting. Think about the legal fees you'll save and the efficiency you'll gain. Plus, computers tend to miss less than humans, so you can trust you're catching every important detail. If you're ready to revolutionize your contract review process, check out DealRoom AI. Because in M&A, time is money. We're here to save you both. Visit dealroom.net to learn more. Here's to the deal. Welcome to the M&A Science Podcast. I'm your host, Kisan Patel. Today, we're kicking off a special two-part series with Dr. Amit Monga, founder and CEO of SARAPOINT. In part one, we'll cover key lessons in corporate M&A, from balancing strategies to managing pipelines and staying aligned with board directives. In part two, we'll dive into software valuation trends and tackling carve-outs. Let's jump into part one. Amit, how are you doing today?
I'm doing great, Kisan. So nice to kind of be on this podcast with you, and incredible all the great work that you've been doing. So I've learned a lot from the previous podcast as well.
Hey, thank you. And we're here live in Toronto. Amit, can we kick things off a little bit about your background?
Sure. I grew up in India and did my mechanical engineering, came to Canada to do my PhD 2 decades ago in artificial intelligence. So I was like maybe 2 decades too early. And then I went into consulting. And then following that, I actually started in a software company, vertical market software for a company focused on higher education. Sold it, came back to Canada, was a venture capitalist for 3.5 years, focusing on life sciences companies. And then spent like 2 decades in investment banking, focusing on technology companies. And now I have my own M&A advisory firm where I basically work with C-level executives and the boards.
PhD in engineering, consulting, founder of tech company, VC, IB, done some corporate M&A. The engineering degree wasn't enough. Exactly. But having said that, a lot of my PhD work is getting cited now, so I'm tempted to kind of start an AI company. So I'm always fascinated by those with engineering backgrounds. Those are the ones that are dangerous in the M&A field. I think you know why.
Listen, it prepares you for a lot of uncertain things. I think engineers are very good at scenario planning. And designing stuff. And as we know, M&A, as you say, is a science. So you got to be kind of looking at all different things that could go wrong and then see how you can mitigate them. So the engineering training is definitely helpful.
Problem solving, zooming in, zooming back out.
You got
zooming
it.
Back in again.
Exactly.
Can we kick off? If you could share some of, just looking at your whole career, all the deals you've worked on from pretty much every angle, what are the key lessons from the trenches that you think are important for anybody in corporate M&A to know?
So, I'm a big believer of starting with first principles. What is the strategic rationale for why are you doing this acquisition? Is it you want to go into a new market? So is it market driven? If you're, we're going to talk about technology companies. That's where I've spent most of my time. Is it like a strategic technology that you want to acquire, for example? So is that what's driving it? Or in some cases, is it people, right? So we are seeing a lot of enterprise software companies today. They're looking at AI companies. So in some cases, the products are not there yet, but they definitely want to acquire the team. So that really is like, I feel what drives that. And then, of course, it has to make financial sense, right, at the end of the day. So I think that's super critical. And then let's talk about corporate M&A. And corporate M&A is very important because it's for a corporation, it's all about growth, right? So they have organic growth strategy, and then M&A kicks in when it comes to like inorganic growth strategy. So sitting down, understanding what products they have today, how do you complement that through M&A? That becomes very, very critical. Sitting down with the board, understanding. So for example, in some cases, when we have spent time with the corporate M&A teams, the boards have said, listen, we've decided that we have a very good footprint in North America. We want to expand into Europe, or we want to expand into Asia, for example. And then in that situation, what we're looking at is basically a corporate M&A strategy with the good direction from the board and proactively looking at targets in that area. And then, also, I'm a big believer of getting the buy-in. I mean, if you do find some interesting acquisitions for a corporation, starting to do a little bit of homework to kind of make sure that the integration goes well. So that's how I would kind of, position some of the lessons and also things to watch out for when you're doing corporate M&A.
First principles, strategic rationale. You're really driving into the why through M&A. And you also referenced the broader corporate strategy, referencing M&A as a tool to use against the broader corporate strategy. And then the game plan execute to have that level of focus on integration.
And, you're going to see in our discussion today, you're going to see I'm going to be using no surprises. So what you want to do is, especially in a corporate M&A scenario, keep aligned with the board, right? So if board says, hey, I think we should be looking at an expansion into Asia or a specific country, let's say in Europe, in UK and stuff like that, want to make sure that you basically are executing on that plan and not going a little bit off strategy kind of a thing. So no surprises, keep the communication lines open, even with the business units over time.
I don't know why. I just want to challenge you on this right off the bat because I'm Indian. I'm just inherently cheap. And I struggle with this because I understand and done a lot of these interviews, and you really understand the value of being cohesive to your strategy and communicating it. But then I'm also deeply rooted in being very opportunistic.
Yeah,
if I see a good deal, it's a good deal. Why can't I pursue these deals, but it looks like it's a 50 cent on a dollar play?
So I think here I'm happy to introduce the concept of what I call proactive strategy and then the reactive strategy, right?
Let's talk about that.
Yeah, so definitely you want to have a proactive strategy, right? You want to keep your team busy. You want to basically make sure that they're tracking your ideal targets, right? And we might be tracking some of these ideal targets and say they're not ready yet, or they just did if it's a private company, they just did a financing. These guys are valued at like $500 million. It's not going to go anywhere. It's not accretive for us and things like that. But there could be some catalyst or some event that happens, and all of a sudden now what you do is that target becomes available. There could be some issue with one of their product lines and all of a sudden they need to basically sell the asset. So I think the key is manage your funnel and at the same time, be ready to pounce on any of these opportunities. And actually, I did that all the time. I would say, what are some of the aspirational companies that you want to go after? We'll continue to track them. And then all of a sudden, someone has to carve out a piece because of the regulatory issues. Two big companies are merging. And there, if you can move fast, you basically win. You basically walk in, you say, listen, fully financed offer, ready to close in 45 days, 45 to 60 days. And the guys are like, perfect. And at that point, if you engage with these people, you can basically say, okay, I want now, like, I basically want an exclusivity. You lock them in and you move fast. So you're absolutely right. You have a proactive approach, and then you have a team that is willing to kind of, be organized to take advantage of these opportunities as well.
Well, I was thinking of the same one. Here's like a carve-out example, which tend to be pretty unique, complicated, but they're not always going to be right in your core. And so you're proactively building a pipeline that aligns with your strategy, but it sounds like there's obviously stuff that comes to you.
Exactly. So listen, a day in the life of a corporate development team is you always are getting inbounds from bankers, right? So a couple of them are like, hey, have you thought of this? And then you ask them, do you have a mandate? Not really, but we're just like testing the market. In some cases, there's this active sell side going on. So you said, hey, we're running a process. Are you interested? Yes. Send us a teaser. We get the teaser. We basically look at it. Are you interested? Yes. Sign the NDA, get the SIM, and kind of move forward. So you always will have that piece. And then you also are doing your second job, which is like, these are the things that I want to buy. Continue to track those companies, continue to track their financings, continue to track, oh, wait a minute, they're laying off people? Does that mean trouble? That's the perfect time to have a conversation with their investor or with their chairman of the board and kind of make that move. So it's always you're tracking stuff.
How do you rate this in your pipeline?
You would rate that as actionable. So, obviously you rate that as actionable based on the information that's available to you at that time, right? So you might say, these guys just raised like $50 million. That gives them another, 2 years of runway. There's no way these guys are going to trade, but something could happen. All of a sudden, it's now actionable. So actionable, non-actionable, 6 months, 12 months, 18 months, 24 months.
Okay, so you're looking for indicators to tag them as actionable.
Exactly.
Otherwise, they're in your pipeline but inactionable.
Or you track them, right? Like you're not intensifying your approach yet, kind of a thing. And also in some cases, like the companies might be valued too high, so it's premature to approach them.
What about these things that aren't really in the corporate strategy, that are out of the scope, and the ones I did fall more into that opportunistic?
So there is a separate bucket of, have you thought of this, right? Have you thought of the idea bucket, and again, like it shouldn't be a totally different business. While obviously in some cases people might say, there are companies that basically are acquiring companies for cash flow, for example, and they're diversified companies. They have certain metrics around financial kind of, metrics that they want to basically track. Their shareholders basically buy their stock because they want to get a certain kind of a dividend. So they look at...
So their corporate strategy is just purely cash flow, financial.
Exactly. Or it's a financial driven. So they don't care, if you're in different industries and so on. But what happens is over time, you become very, a certain industry really well, all the players. So you start kind of, acquiring those companies in that space. But there are examples where there will be companies that actually have very, very different businesses. Now, so that's one example. The second one would be where you kind of look at something and say, hey, wait a minute, can't I cross-sell this product to my existing customer base, right? Or I want to go into this space. The only way I can do that is by actually acquiring the company. Mm-hmm. So, I think there was an example of FedEx and Kinko's, right? So what a great example, right? You basically have FedEx. We all know FedEx, delivery company, but you also ship documents, right? So it's I got it back in the day, right? So some of the people who are like, what is that? Did you actually ship documents? But you would have to photocopy stuff. I remember when I started in investment banking, I had to carry pitch books with me to meetings, right? So a lot of times I would get on a flight from Toronto and my assistant would say, hey, another person there will be at Kinko's. with all the photo, like, all the pitch books, color copies waiting for you kind of a thing. So now you kind of say, hey, this makes perfect sense because you basically have a courier company and you're basically acquiring a company which is a destination for documents kind of a thing.
That's helpful because I always struggle with how much weight do you put on this anticipation of synergies on the deal you're doing versus I'm just being hardcore opportunistic and buying at a discount, and prioritizing that.
It has to be a combination,
Well, that's the best. If
yes.
you do both.
Yeah. Like I think the synergies have to be in your model, at least in these scenarios. There are also examples of companies that what we call consolidators. They are software companies that do consolidate companies. And in some cases, they say it's actually absolutely fine to run them separately because sometimes they're buying companies and they're saying they're profitable. We don't need to create artificial synergies kind of a thing. If organic synergies automatically happen, that's fine, but we're not going to force shared platforms for HR or not force a shared platform for different financial systems. Let them happen organically. So what is an organic synergy? It could be like acquire two companies. We're not planning to integrate them, but wait a minute, we all buy Microsoft Office. We can leverage discounts, the company discounts. So synergies automatically start falling in, but you're not forcing it. So I'm not starting with saying, wait a minute, we have 6 people in HR here, we have 12 people here, we only need 8. So we'll need to kind of figure out how do you do that.
I've seen this play out where you go through the modeling exercise and to make the numbers look good and get the deal approved, you tend to forecast a lot of synergies.
Well, the thing is like on buy side, especially if you're in the if in the corporate M&A team, at the end of the day, you need to defend your numbers. Like people will come back, they will say, actually, your platform does that a very good job. Not to kind of plug in DealRoom here. I think one of the unique things that you have is like integration monitoring, right? At the end of the day. So funnel, transaction. As an iBanker, I basically spent most of my time transactions, right? It's like, not my problem. Let's move on. It's like, hey, like, man, Amit, we did that acquisition, people don't like that. It's like, okay, not my problem. But if you're in a corporate M&A team, you are kind of like, you own it, right? So when you model synergies, as a matter of fact, what I've seen the best practices, you underpromise, overdeliver. So you basically model synergies, but you're very conservative so that you basically want to make sure that it works out well at the end of the day. So that's also is a very big difference between buy side and sell side M&A.
That's a good point. Be conservative, modeling synergies, game plan to execute. Big part of it's integration. We're already coming back to emphasize integration. How do you approach just even the fundamental decision of, do we integrate this company? If we do, how much do we integrate it?
Culture, right? So let's say I'm an enterprise software company, old school, the IBM days, my Navy blazer, my Dockers and so on, and I'm selling to the banks. And all of a sudden I have to actually acquire a fintech, or I have to acquire an AI company. I go to the Valley and it's, it's a totally different culture. There is no way I'm disrupting that culture. There is no way I'm kind of saying, hey guys, actually we all come to the office 8:30 in the morning, and these are the things that we do. We have company offsites and so on. We need to kind of make sure that these acquisitions that we do come with a different culture. That's the reason they thrive, and we want to make sure that they thrive in that environment. So you basically kind of bring them into the fold, but you do not integrate them, fully integrate them. Now, it's easier if that acquisition is in another continent, right? You're not going to run into them, right? But it's harder. Let's say you acquired a AI company, you're headquartered out of New York, and you acquired AI company in New York. It's kind of tough because it's let's say you and I are corp dev team, and now we're going to our quarterly meeting, we're going to go and visit them. It's Amit, you got to dress down, man. Don't wear a suit. These guys are are in sweatpants and, whatnot. And so you need to be very cognizant of that. Now, if you're in a different country, it's not, it's not an issue. I've looked at companies in India, for example, right? Totally different culture, work ethic, and so on. I've looked at companies in France. So here I am kind of saying, okay, guys, our perfect. So we will be meeting in August for our quarterly updates. The guy's like, we do not have any meetings in August. A lot of people take time off in August in France. I was like, oh, okay, yep, that's true. Need to move things around. So I would say when the cultures are different, integration becomes tougher. Having said that, there are a lot of things you can do behind the scenes, right? Like I'm in financial systems and things like that. One of the selling points for a big corporation, for example, that wants to acquire like an AI company would be, listen, we'll take over all the stuff that you hate, right? You don't want to hire 10 people. We've got a machine here. The HR machine will take care of it. You just guys do what you're supposed to do, kind of a thing. So that's the way I kind of see that. I think it's very culture driven.
That's interesting. Big emphasis on culture and the likeliness in developing your strategy for integrating the company. Let's play. I got one for you. So
Sure.
I have an investment thesis to consolidate data room companies. We own
Okay.
a data room product called
Yes.
firmroom.com if anybody's interested. And the idea was taking these old data room platforms out there, a lot of small companies, been around 15, 20 years, pretty stagnant, slow declining, and cost synergies, like migrate the customers on the new shiny platform, better experience, and then cut costs everywhere. But I come across a deal in another country and completely different culture. In fact, just the whole ecosystem is very different. The way they operate, and you can tell the product is actually really good. It's not a bad product that's that far behind. So they're pretty updated and they have their way of working. How do you look at it on that example? Because it goes completely against the thesis. In fact, I think the more you try to integrate, the more you're going to break things. And the company's profitable, 35% EBITDA margin. Do you still look at that deal, or do you say, hey, this doesn't fit in the thesis because it's not going to drive the cost synergies that we anticipate, and we're sort of going global too fast?
Great. I've been through those scenarios multiple times. It's a great kind of, now you
teach me what to do.
Yeah, exactly. You're getting free advice now. Like, what's going on?
That's it. People don't know. That's the reason I do this podcast.
Right off the bat, if it makes financial sense, I'll go for it. If I've got the right valuation, right, it has to be very important for me. The valuation is right so that financially it makes sense for me, right? I actually would run it as standalone for almost a year, kind of a thing, and let the synergies happen organically. So what does that mean? I think I'm going to run it. Of course, you do your due diligence based on what the company is today. Standalone company. It's like if you have your own private equity fund that exclusively invests in deal rooms, or how would you evaluate that company? And you have your criteria, whether it's 20% IRR or 30% IRR. You do your math based on that, right? And then you basically say, okay, I'm going to actually bid on this company. And they say, hey, we really like you. Absolutely. Acquire them, continue to run them as a standalone company. It's 100% like own sub of DealRoom now. Now what you're going to start looking at is the next 3 to 4 months is your best salespeople kind of looking at their customer list and saying, can we upsell them something? Right off the bat, I'll tell you, I don't know, I haven't seen that many products that actually has an end-to-end platform from a funnel to a transaction to integration monitoring. So let's say if those guys were primarily catering to investment banks, for example, investment banks really don't want the integration piece, right? They just want the deal room. They want the data room. They want to track who's reading the docs. And they just want to, basically it becomes like the deal room pops up when you sign the mandate letter, and then it disappears after the deal is done from an investment banking perspective. But now you can say, go to the guys and their salespeople. I was like, hey, we actually have this product, and you have been working with some of your corporate clients, and have you offered them the second piece, which is basically post-acquisition, right? So now you're like slowly introducing your innovation into their product, right? So now this is where a little bit of technical piece comes into play, because now I'm used to seeing a certain kind of dashboard. Now, how would I integrate or seamlessly transition into a DealRoom's kind of, the next module, if you will? So that's where the science and the art of the science kind of, comes into play. So I would say you become like, you know what? If you know your space, you know your end markets, you know your customers, start doing the consolidation, but don't start with the thesis that it only makes sense if there are synergies. The synergies, in my opinion, is like if you can really realize the synergies, that's where you actually make that extra kicker.
I gotta admit, I'm impressed how much you know our business. I like how you already gameplayed this out.
Shout out to Lizzie for that demo. Like, I mean, she wouldn't leave me. Like, she's like, okay, I gotta go through this, and have you seen this? So he's like, oh, we ran out of time. Like, we haven't done the AI part. I'm like, okay, I want to see the AI part. So I always set up a follow-up call to do that too. So,
but in this view, in this example, it's less about being part of the thesis, almost like a hypothesis.
Yes.
Like we'll sort of take note of it, but we're not going to factor it in. We're going to buy this, assuming that we're operating it independently,
yep,
have it make financial sense, but it's in the same realm. And there is some unknown likeliness of getting some kind of synergies there.
Absolutely.
And then learning the market, because we do want to get to Europe, but we're about 2 years out in the current roadmap. So at least it sort of gives us an opportunity to start learning the European market with working with this business.
Imagine you're at a European private equity M&A conference and they have a booth, right? This company. And you basically send one of your, really good salespeople, ideally pick someone who's culturally aligned with that country, right? Like, I mean, we live in North America. We can always find someone who has a connection somewhere, right? And watch what questions people are asking, and then have this person say, hey, by the way, this is my colleague, he's visiting from Chicago or New York, and this is the product they have. It's like, you know what, we could really use the integration piece, because the M&A piece was seamless because we had advisors and stuff like that, but now I got like spreadsheets to track like integration. It's like, well, we can show you a demo kind of a thing, right? And so phase one could be that it's their product, but then you sell them the separate module. But over time, hopefully, you can actually create a technology roadmap that's fully integrated.
It's a pretty good example of just how to role play this out in terms of what the plan is to integrate a company.
Yes.
This example, doesn't have the cultural element, so we keep it as a standalone. I guess on the other example, that might be a company like, for example, that we have a partnership with. Let's say one of the data providers.
Yeah.
I don't want to cite anybody specific because somebody's gonna ask me some questions later. But let's say we have a really good partnership with one of the data providers,
sure,
which most of you listening to this probably already know. And then we decide to acquire that company. Again, like tight partnership. We're already doing some joint sales together. In that case, there may be a totally different plan, right? They're both similar. We're talking about they got team members in New York. They're all in New York. We got team members in New York. Go back to the New York example.
Yes, yeah.
We could probably consolidate offices even and do some interesting things. But that we're starting to look at more of a full integration in that scope.
And again, I would say my advice there is don't aggressively lead with that. Like, say, okay, this is the integration plan. Let your M&A thesis be creative without overly emphasizing the synergies, right? Because synergies can also create stress, right? Like, I mean, people move, you're like, oh, we don't need this person. Well, oh, really? Wait a minute. This person actually is very close with the star salesperson. Oh, if that person leaves. So I think what I do is in those scenarios is model some of the synergies, which are non-people synergies, which are less disruptive. Offices, awesome, right?
Yep.
Actually works really well if you have really old, someone has like really old offices, and then you move into these new offices, right? Like Hudson Yards. Oh yeah. Like, I mean, like, you kind of, man, like I was in this like building here. Now I'm in Hudson Yards, like things like that. So that piece is great. A lot of people like the fact that they get, newer IT equipment or they have better tools. In some cases, like it was as simple as, man, you know what I love about your new R Acquire? They have a great expense management software because like these guys are like never grew up from the startup. Like the CEO like said, I'm not investing in expense management software. We're going to just do it on Excel and you got to submit it. Everyone hated it. They're like, we just love this. So these things just happen automatically, kind of a thing, right?
I was one of those CEOs, by the way.
Exactly.
Thanks to our new CFO, we
Yeah.
changed all that.
Exactly. So, I would say synergies on, more kind of real estate administrative stuff rather than kind of focusing too much on people. People sometimes over model people synergies. You have to be very, very careful about that.
These are really good points about the emphasis of integration. It seems like you're thinking about this pretty early. And one of the things that I've been doing a lot of content around is just the whole buyer-led evolution. How a company starts off, maybe first deal is very seller-led, but as they do more deals, it just becomes more and more and more buyer-led.
Yes.
What's your experience been like, and what does that actually mean?
I think from my perspective, the more transactional experience you get, the more people on your team have the transactional experience, the more kind of institutional intelligence you start building in, kind of a thing. You start anticipating what people kind of, underestimate, overestimate, over kind of emphasize, and the ability to basically, have that conversation early on, kind of a thing. And then creating that kind of, in my opinion, almost like playbooks, if you will, that you can test early on to kind of make sure, is this the right kind of, company for me to kind of bring it into the fold or not? So what I've seen is companies that have a very mature corp dev department have very well thought out kind of acquisition playbooks. They also track lessons learned, which they basically discuss in real time. There is no shame in saying this didn't work. I think we underestimated X. We should not underestimate that next time, kind of a thing. And having those lessons learned and revisiting them every time you're making a move becomes very, very important.
So it sounds like a big driver of being a strong buyer-led M&A team is building the M&A muscle.
Yes.
Actually getting some reps in. Right?
Exactly.
You got the work fundamentally. But then along that, to help with the efficiency of building that muscle, this is like taking the supplements, right? You build your playbooks along with it. You sort of track the lessons learned from your retrospectives.
And you tweak the playbooks. Like, you don't have to, you have to fine tune it. Things change over time. For example, be very, very cognizant of regulatory kind of, frameworks in different geographies. In some countries in Europe, I can't lay off people like post-acquisition kind of a thing. And so don't even start with like any of that modeling, for example.
What does that mean when the rubber meets the road, when you're actually working with the sell side, or specifically even a sell side that's working with an investment bank that wants to guard the process and have control over how the things run?
In that case, if I'm a buyer, so again, goes back to transparency, communication. I want to keep, if I'm on the buy side, if I'm the guy who's acquiring companies, whether it's like a software play where I'm acquiring consolidator, or I'm a strategic who is very interested in these assets, the worst thing that can happen to me is I read about a potential process being launched in a Wall Street Journal or a Financial Times or on CNBC, right? Because I'm like, what? These guys it's out there, they're selling, and we don't know about it, right? So,
That's bad.
Yeah, that's bad, right? So what I want to do is, in that situation, if these are my prime targets, I want to track who are they hanging out with, as in who are their sell-side advisors, right? In most of the cases, sophisticated sell-side advisors, I was one of them, I would basically, before even launch the process, would at a very high level, under the confidentiality and so on, saying, hey, have you thought of this combo? Would that make sense to you? And what I want to get out of you at that point is what things I don't like about the deal. It's like, man, yeah, absolutely love it. But, they have this operation in Asia. Like, there is no way my board is going to let me own that piece, right? Given the geopolitical stuff, or or they have a development shop in one of the, let's say Eastern European country that's in a conflict. So I was like, okay, perfect. I know what you like and what you don't like, right? So you start collecting that kind of, intelligence. And it's my job from a buy side to actually have a track of like which banker is close to my target, kind of a thing. If they decide to sell, who's going to get the sell side mandate, right? And sometimes it's actually very mathematical too. Like if someone has lent them a lot of money, in some cases you can basically figure out like which investment bank at least will be called to the beauty contest and stuff like that. So what you want to do is you track that. And then from there, you basically build out your thesis. So you kind of have to say, these are the companies I like. I have communicated to them what I don't like. And then they might come back to you and say, listen, Amit, actually, you're not the only one who has that concern. So we've already told the board, if you really want to sell this asset, you need to carve that out, right? So all of a sudden, they've got a separate mandate. Is someone going to buy their Asia business, for example? Maybe SoftBank is interested in buying that piece, kind of a thing, because they're very comfortable with that geography. All of a sudden, everything has changed now. And then now you are engaged in the process.
That's to get in the process in a good position.
Yes.
That you're sort of in there and you want to be the favorite.
And you know what? Like, you're trying to create all the favorable conditions that will help you to pitch this internally, right? Because so imagine I come to you and you're the chair of the board. It's like, Amit, like, thank you, great idea, but how many times you've been in our meetings and we said, we do not want any exposure to that geography. What are we going to do with that? Like if someone would say, oh, we buy the whole thing, then we were going to sell that piece. No, we just want this piece. But if you've communicated that with the company and a lot of people are asking the same question, then they will be proactive and they actually will get two mandates. They will to sell that piece and this piece separately.
I like this. This is being buyer-led, but even very proactive early in a process that likely is going to get banked. You get not only that communication with the target company, but the banker that they're likely to engage. So then you've got some communication there, of each other. How about when, if it's, they're still running a competitive process, right?
Mm-hmm, yeah.
And that's part of it.
Yes.
So at least you got strong positioning.
Yeah.
And you're going to get to LOI sign.
Mm-hmm.
And I feel like this is when execution really starts.
Yeah.
How do you maintain control from execution onwards?
Very, very, like you got to identify what are basically the key risks and what are absolute, things that you need to be comfortable with. You got to start with those priorities and not kind of leave those till the end kind of. So my priority list of things that are absolutely critical that are showstoppers for me have to be addressed first. And I got to go through them. Customer contracts, right? What's the nature of the customer contracts?
Yep.
What are the outs, right? It says a 2-year contract, but if it says 30-day out, okay, wait a minute, that's not
they either have a cancellation clause or a change of control provision.
Exactly. So things like that are absolutely important for me. I'm going to start with that. And then you're just managing that whole process. But then then you have this paratrooper, commando, surgical strike team kind of a thing, right? And then we're churning stuff. And keep that communication line open with the advisors. I absolutely love when there's an advisor on the other side because they become your partners, right? It's like, hey guys, we don't like this. Has anyone else? They're like, man, yeah, that's a really weak contract template they have and so on. So constantly keep on communicating to them about that because you know what? That may have an impact on my price because it I might basically not give them the same revenue multiple or EBITDA multiple because people can get out of those contracts easier and so on. So
Was that common? Would you go back and renege? But you would ask ahead of time. You'd say, "Hey, out of your contracts, like, what do they look like pre-LOI?"
No, we can do that, and also the companies are sophisticated. Like if they really want the company, they know like post acquisition, they can also bring in the customers and sign a new contract with them, kind of a thing.
What about staging it with the whole control of the process itself? Because bankers like to control it. They like to stand up a data room and send a bunch of Excel sheets back and forth. But you're there. We talked a little bit about the cool tools out in the market. I won't discriminate against my own, but the fact that you could do you still push to control the process, or do you still sort of abide by the banker?
I think there's a banker process, in my opinion, that is like high level, and underneath we're micromanaging the process internally. And we just want to make sure that we stick to the guidelines and we stick to the timelines that have been proposed by the bankers. So it's like, the offers are due by this date, or the last set of questions are due by this date, and things like that.
But what about from LOI to close? That's still...
LOI to close, I think that's where you really work with the bankers in investment banks and so on. I think you just need to have like a working relationship with that team. And when I say that, I mean actually at the junior level, analysts and associates working hand in hand to kind of, do things like faster. And then issue management, issue resolution happening at the MD level.
And then I was trying to get at was, just the, I was curious about this because I feel like this is what the crux of the industry and how it's shaping when I start thinking about the process being more buyer-led, is that from the LOI point, I think there is a power dynamic shift that the buyer can all of a sudden start dictating, hey, here's how we want to run our sort of confirmatory diligence, where, they don't have as much pre-LOI to be able to leverage of how they want to actually get that done.
It all depends on how much leverage they have, in dictating that kind of process. But I've never taken this approach of like, I want to take control. I'm very kind of like
collaborative,
scientific about this thing. It's like, these are the 20 things I need to go through. This is the time frame we have. Let's get there. Okay. Where's the information? And we're churning that document in real time on a daily basis. And we're basically saying, where are we on this due diligence? Where are the employment agreements? Where are the reps and warranties? Things like that. So I think that's where I think the corp dev team, the buyers team has to at least show some leadership. Because I think at that stage, the bankers are also looking for direction, because they've brought you to that point. They're very motivated to close the deal, but now you want to make sure that you actually are kind of, working hand in hand with them and showing them exactly what you need to kind of close the deal.
Yeah. So just being really transparent and clear about what the priorities are to get you through the confirmatory diligence process.
Exactly. And communicating that.
Does that change at all if there's not a banker involved and you're doing a proprietary deal?
Yes, it becomes complicated, because every interaction could become an education process. It's like, really?
But is it a good thing?
I needed this. I'm like, man, here we go again. I got to explain to them that they needed a non-compete, or, things like there's just basic stuff that we just take it for granted, right? Like in big deals, everything is you've got the best lawyers, when the company was founded, they had the best VCs. Everything is top notch, right? Because there was solid due diligence done at every meaningful stage of the company, whether it's equity financing, debt financing, and things like that. So when you come to that stage, it's tier one investment bank led the last financing, obviously, top lawyer, law firm, boom, everything is kind of, should be fine. Now you're looking at bootstrap business, 20 years old, great business, entrepreneur wants to sell the company. And it's they're having a good time. They're like, yeah, I think I should retire. I'm 60, And at that point, actually, what I want to make sure, first of all, is there a catalyst? Or is this just a price discovery, right? Because I don't want to spend all my time going down that path and saying, I changed my mind. You know what I mean? So A lot of times you're looking for the catalyst. And in an ideal world, there should be an advisor, because that really means that they are paying someone to actually sell the company. But coming to your question, what if you don't have an advisor?
Yeah, because I wanted proprietary deals. From my experience, they tend to be better deals.
They are better deals, but I think if you're going to buy them, and you need to be very fair to them. This can't be a gotcha moment kind of a thing.
I think that's fair.
I think you need to basically give them that comfort level that what the value that they're getting is actually fair market value, because you don't want them to be a disgruntled shareholder of your company or part of your company. So I spent some time with one of the conglomerates, where we had a very active proprietary pipeline of companies that were bootstrapped. But there, what we did was we basically spent time with these management teams. In some cases, when I looked at the notes, over 15 years of building a relationship. At 50, there's like, hey, have you thought of selling the company? I was like, no. And they keep on chatting. At 65, the guy's like, you know what? I think I am ready. But you know what has happened over those 15 years? They basically said, listen, just as a friendly advice, if you want to sell this company, make sure you have X, Y, and Z in place, right? Like things that you need to have in place before you sell the company. So make sure you have the right advisors, like even law firm, for example, right? Like this can't be your friend who kind of closed your house, like, hey, son, you're my lawyer. Like, can you kind of put a shareholder agreement? Sure, why not? I can Google something and put something you want to make sure everything is defensible, because what we tell them, listen, the better the quality of your internal documents and how the structure is, the higher the value you're going to get. So you have to, I think, be a trusted advisor in that case as well. So you are like their sell side advisor, but you're also going to buy the company. And at that point, be prepared if the guys are like, hey, Amit, I really appreciate it, but I think I'm going to run a process. Not a problem. At that point, you got to say, you know what? May the best person win. And you hope that the investment of time that you've made in this company, they feel much comfortable coming to you than going to someone else. In some cases, price is the only thing people look at. But I would say in bootstrapped businesses, proprietary businesses, they really care about their customers. They really care about their people, because a lot of people work with them for 20 plus years and they're like, how are you going to take care of my people? How are you going to take care of my customers? Check. You know what? I'm going to go with you. But I've also been in that situation. The guy's like, I'm going to go with you. And then, I just went with the guy who gave me like 10 million more.
I had a deal I was looking at. Well, I should say hypothetically, but I had this deal I was looking at. And same thing. We're going to engage a banker, right? Already started the early conversation. I bowed out and said, hey, let me know if that process doesn't work out.
Yeah.
Now, my thinking is if they do come back,
you want to 100%. But at the same time, I would say that's not the time to lowball them. Okay. It's I think you need to still be fair. I'll give you an example. We came close and the guy's like, sorry, we're going to go with a PE shop. No problems. No hard feelings. All right. We walk away. 8 months later, inbound. Hey, we want to talk to you. What happened? Well, we were with this private equity company and they basically said 6 months, this is our 6-month plan. This is our 12-month plan. We need to cut down the FTEs. It's the top senior guys are all my friends. We stay in the same kind of, golf community, and I can't lay off that guy. He was with me.
They didn't do the deal.
Right. So they didn't do the deal. We acquired the company.
Okay, now I should give context. In my scenario, one, I'm playing the opportunistic persona here because we're still small balance sheet company. So, and I'm Indian, always looking for a good deal.
Absolutely.
Right. So that's where I come back and say, okay, I know where I'm at, and I know if they run a competitive process, it's still a crappy asset because I'm looking only at crappy deals.
Sure.
Right now.
Okay.
Not to knock anybody if I knock on your doors, but it's that's what I'm betting on is look, I'm going to be on the lower range, so I'd want them to run a process if it doesn't work, which has actually happened before, during the right market.
Yes, exactly.
Run
exactly.
it, nobody comes and they come back and you're like, okay. But what I was curious, is that the right approach? Am I communicating the right thing? Maybe given this certain situation where I know I'm being very opportunistic and price focused on the value, because it's more of a distressed situation that I'm buying in this scenario. Or am I communicating a little wrong to that banker? Should I be a little bit more, hey, I'm happy to stay along, but I'm not, how should I be communicating that?
I would say that have a very amicable parting of the ways. Like, do not close the door, right? Do not like slam the door, like shut, like as you're walking out. Say, listen, like where we are, where my kind of, investment appetite is and return appetite is, it's very hard for me to kind of pay more. There definitely will be someone else a strategic or someone who could pay more. I think you should run the process, but I just also want you to know I'm around if this thing doesn't work out. That has happened to me all the time, kind of a thing.
That sounds pretty fair.
Having said that, now what I have now is, let's say it's 8 months, 6 months, 7 months. I also want to understand, why was this a hung deal, right? Like, why this deal didn't happen. So I think at that point, I can talk to the guys and say, hey, who were the people looking at it, and what happened, kind of a thing, right? And I think the bankers, they'll say, yeah, sure, off the record, kind of, these were some of the things. And also, this is also my time to now revisit, has the quality of the asset kind of, deteriorated? For example, what could that be? An example could be key employees left, or the CTO left, or top sales guys left, or they lost a big customer, right? Like they had, DealRoom has like, a one corporate client, like, that actually is using it in like multiple, like if that's the case, I actually now have the ability to renegotiate my price. I can now look at their CRM, I can look at their sales pipeline, and I can adjust my numbers.
That's some of the thinking I have on some of these assets. It's like they're not going in the up and right direction.
Yes.
They're going down in the right. So it's a little bit, time might be on my side.
And actually on that point, like, like a lot of times people was like, I was like, what? Like, this pro forma doesn't make sense. Like, what are you trying to show me? It was like, well, we model synergies. Like, you model synergies, you want me to do the synergies, and you want me to pay for them upfront. Like, it doesn't kind of make sense. So it's very important to kind of say, I want to see your asset as a standalone asset. I'll do the modeling, because modeling comes with basically its own risk profile, because I need to put it on a curve. Like, it might happen, it might not happen. People are trying to model, oh, you have an office in Europe, you can easily cross-sell this to other, like, I'll make that call.
Yeah, that's what I don't like. And that's why sometimes they get turned off when they're like, I know you got the banking background. We both got banking background. It's like when they bring the banker in, that's what they're going to do.
Yes, yeah.
The chart goes further up and further to the right. So it's like, I don't want to mess around with that, because it's, again, I guess that's an interesting conversation too, because they put that, let's put all these ad backs in.
Exactly.
So how do you handle that conversation?
So I think, this is actually a great kind of discussion, because sometimes I kind of look at it. I've seen it's a very generalized statement. If I'm looking at assets from private equity shops, sometimes they are like margin optimized to sell.
Yeah, very common. Yeah.
Margin optimized, right? So it's like, wait a minute, you're selling, like, you have 30% sales on West Coast. You have like one salesperson? No, we actually had 4 salespeople, but now we only have 1. Well, the thing is, like, I probably will need to hire at least 2 to keep that momentum going, kind of a thing. So you kind of have to very be careful in terms of, like, is this model that you're seeing is a steady state model?
That wraps up part 1 of our conversation with Dr. Amit Monga. We covered corporate M&A fundamentals, from balancing strategies to building pipelines and staying aligned with boards. In part 2, we'll tackle software valuation trends and carve-out challenges. Don't forget to visit mascience.com for more tips, and follow us on LinkedIn for our social content. See you next time on M&A Science.